Hi there. Welcome to Economic Observations. Today is Thursday, the 13th of January. Thanks for being here. This video is sponsored by the Tanzania School Foundation, a nonprofit near and dear to my heart. There are links in the description below, and that artwork behind me is for sale, benefiting our work in Tanzania. Let's get started. Yesterday, 8,000 Kroger employees walked off the job and they are on strike. They are demanding higher pay. Kroger bought back $1.5 billion worth of stock, and the CEO gave himself a 45% raise while reducing hazardous pays for all of their workers. Power to the workers. I wish them the best of luck. 14% of them have been homeless or living in their cars. Another 14% are on SNAP benefits, meaning they work in a supermarket and they can't even afford to buy the food with their meager wages. 34% of them can't pay their bills, and they're demanding higher pay, better insurance benefits, and better overall working conditions. 2020, these workers were the heroes, and today they are forgotten. It's happening all across the country, across all sectors. It's unbelievable, really, that here we are today with profits, record profits. So Kroger is the largest supermarket chain in the United States, and sales soared through the pandemic. The company reported a profit of $2.6 billion in 2020. And Kroger's CEO, Rodney McMullen, received a wage increase of 45% to $20.6 million. The company authorized another $1 billion towards stock buybacks at the end of 2021 after repurchasing $1 billion worth of stocks in the first 3 quarters of 2021. They can't afford to give the workers a living wage. Something is wrong with this country. I feel sorry for young people today. I started working at Goldman Sachs long time ago. Long time ago. It was a small partnership back then, before the IPO in 1999. I worked there for a long time, and we enjoyed the profits of the company. We were treated like family. I knew some of the partners. They treated us well. I was proud to work there. There were no shareholders. Their workers were the shareholders. They were their number one asset, because without them, they couldn't do what they do. Today, no corporation is like that. Why would you want to work for someone who only cares about the stock prices? I don't know. This world is crazy. There should be profit sharing. There should be enrichments and incentives for people to do a good job. There should be growth in a job. Today, there's none of that. And I don't know where we're going with this, but the inequality is just growing massively. 14% of their workers are on food stamps. Just unfathomable, really. The next thing, I'm just going to give my little opinion, and I found an article on MarketWatch that kind of coincides with where I'm going, and I'll put a link in below. But we all give so much credit to the Fed, right? The Fed is the almighty. They have tools in the toolbox, and they are going to nip inflation in the butt by raising interest rates. But I don't think that it is the right tool to combat inflation right now. I just don't think it's the right tool, because supply and demand are not at equilibrium. And in order to raise rates, you need to have an equilibrium between supply and demand. Now follow me here, because I'm going to try and explain this the best way I can. While the CPI index came out at 7% annually, that inflation is 7% higher than it was a year ago. The Federal Reserve is signaling that they are going to raise interest rates, but would higher interest rates really quell the inflation today? In this environment. In a normal environment, it would. But in this environment, I'm not sure. The reason I say that it's not the right tool, it's like giving the wrong medicine for the wrong sickness. And I think that the Fed can tweak demand. They have no direct input on supply. And I think there's a misguided They're not aligned right now. So yeah, so the Fed could say, well, we're going to limit demand by raising the interest rates. But if the supply still can't manage the demand, the prices are still going to be elevated. And I'm not saying that interest rates shouldn't rise. I'm just saying that where we are today, I'm not sure it's going to work. I think the Fed is given way too much credit for this monetary policy in this situation. All right, so let's take last year for example. Personal income soared during the pandemic. People were given stimulus, debt relief, tax abatements. They were given extended unemployment, and people were flush with cash. And they were buying things at a higher level because they had more income. But real incomes today are just running at 1.5% pre-pandemic levels. So that means they have less to spend now. And while some people have cash stored away, not everyone does. Not the struggling Americans that can barely keep up with the rising rents and the inflation of goods that they need. See, the aggregate spending isn't out of control either. So by raising rates, you're not going to limit spending because people aren't spending. Credit at the low rates that it has been have not been tapped into. Right? People's debt has increased 2.2% over the past 2 years, meaning that they're not really borrowing. Businesses haven't been borrowing. It is the lowest that businesses have been borrowing in the past 8 years, aside from the 2020 pandemic ultra low business loans that they got. They are just not tapping into the low rates. So by raising rates, is it really going to affect anything? Or is it just going to make it more expensive for people who don't have anything, who have to borrow, and they can't afford to borrow? I mean, the divide is getting bigger and bigger between the haves and the have-nots. And if you have, then you can afford the higher interest rates and the inflated prices, because I think they're going to double up on top of each other. Because if supply is not met, people who can will still buy, and they will be willing to pay the inflated prices and the higher interest. I don't think the higher interest rates are going to have an effect on demand, because I just don't think the demand is there. Does that make sense? But as for companies and valuations and people trading stocks that are massively overvalued, well, they have to come down. And maybe higher interest rates will prevent the stock market from getting out of control, because that's an asset too. And maybe it will reduce the price of housing, but it'll take years to see the effect. I'm not sure the Fed can get us out of this. I think that we are heading into some kind of recession because prices are still going to be inflated. And the people who can afford to buy them at the higher interest rates will continue to do so. And companies will be forced to keep the prices elevated because the demand won't be there. I don't know if that makes sense to you, but I'm trying to think about the whole process here. Yes, interest rates have to rise. People who save need to get a decent return on their money, especially for inflation. Do I think prices will come down once the supply and demand are at equilibrium? Yeah, I do. But I still think it's a supply and demand problem, and it's not leveling out yet. And maybe what the Fed or the government should do is work on the supply side to level the prices so they are at an equal playing field. Anyway, that's all I'm thinking today. That's what I'm thinking today. Anyway, I'd love to know your thoughts. Thank you so much for watching. Comment, like this video, call someone, tell them you love them. Be kind, and we'll talk again soon. Have a great day.